You're welcome to today's class. We're going to look at performance analysis, and that is to PM. Now, PM talks about performance management, so you must understand the meaning of performance. And when we talk about performance in an organization, what it looks like, there are about 6 things we're going to look at: measuring performance, financial performance indicators, non-financial performance indicators, performance and long-term view, balanced scorecard approach, then Fitzgerald-Moore building block model. Now, Fitzgerald-Moore building block model has been covered in CSME, so I won't touch it. So I want to focus on the other 5. So we'll take the first one, as the case may be, measuring performance. Measuring performance. So when we talk about measuring performance, it's taking account, of what you have done as an entity. Performance relates what the organization has done or what the organization is planning to do in the time to come. Now, it is important that we compare where we are now and where we were and where we want to be. With this comparison, you can tell if you are performing better or not. Let's bring this home. Let's bring it home. You as a person can carry out self-appraisal to know where you are, where you were, and where you are going to. This will build confidence back in you, telling you, yes, you are on the right track. You understand? Performance management deals with setting of goals. You see, when we talk of performance management, we're looking at setting a target for the organization, measuring actual results in the organization, comparing targets and results, and taking corrective action as the case may be. Performance can be measured financially and non-financially to ensure that the organization objective is achieved. You understand? So when I look at financial performance, we're going to look at performance of an entity in terms of finance and performance of an entity in terms of non-finance. These are 2 different things altogether. Now, when we talk about financial performance, we want to see the goal of the organization could be profit maximization. In fact, it is always profit maximization or shareholders' wealth maximization. Now, you have to measure to ensure that these goals are being achieved appropriately. That is what financial performance deals with. Now, non-financial performance, these are performance, measuring performance that never relates to finance. Example, innovation. How innovative is the company? You understand? How are the companies meeting up the customers' expectations? You see, it doesn't have to do with money. Are customers satisfied? You see, I once saw in Access Bank where if you are leaving, they'll ask you, how was your experience? If you can take good, bad, worst. That is performance appraisal. They are collecting information about their services to you as a customer. Are you okay with it? You see, this is what we call non-financial performance indicators. Delivery, labor turnover. How our employees, are they satisfied? Is it after training of an employee, the employee leaves to another organization, then you begin a training again, and mistakes and all that? You see, so we must monitor this non-financial performance to ensure that it works perfectly well. Then we have performance management system. When we talk about this management system, this is a system of management that sets targets, measures actual actions, compares the target and the actual actions, identify deviations, take corrective actions, and ensure the deviations never repeat itself again. That is all for that. So move to the number 2, financial performance indicators. Now, financial performance indicators are those things we use to measure performance financially. You understand? There are different aspects of financial performance indicators. We have absolute measure, financial ratios, variances, Now, financial ratio is what we'll concentrate on. Variances will be studied when we look at standard costings and variance analysis. Now, financial ratios. We have different financial ratios. We have profitability ratio, we have liquidity ratio, we have financial ratio, and efficiency ratio. Now, when we talk about this ratio is actually relating one or two numbers together to infer a meaning that the numbers independently or individually wouldn't show us. You understand? So we now look at for FPIs for profitability. We have looked at return on capital employed. It is equal to profit before tax divided by capital plus reserve plus loan. Return on investment is equal to profit after tax divided by investment. Now, percentage annual sales growth. Now, you want to monitor about 3 years, we call it comparative figure in practice, to see if we have been growing in sales or not. So we have profit margin, which is profit before tax, all over sales times 100. Although there are many ways we can define profit. We have profit before interest and tax and depreciation. We have profit before interest and tax. We have profit before tax. We have profit after tax. Whichever way you decide to define your profit, it must make sense in interpretation, because ratios don't actually make sense until they are interpreted. You see, ratio raise questions but do not prefer answers. These are weaknesses of ratios, which we shall look at as we progress. Now, we have cost sales ratio, comparing sales and cost of sales, comparing sales and admin expenses, comparing sales and distribution expenses. So we have FPI for measuring liquidity. There are about 3 FPIs for measuring liquidity in an organization. One is current ratio. It has a formula: current assets over current liabilities is to the power 1 to the ratio 1. We have quick ratio, which is current assets excluding inventory divided by current liabilities is to 1. Cash ratio is equal to cash and cash equivalents. Cash and cash equivalents divided by current liabilities is to 1. There are reasons why company might be having liquidity problem, but that is not why we are here. So we'll now look at FPI for measuring financial ratios. This is a risk that an entity will face when any of the following events occur. You see, 1, debtors fail to pay up as and when due. 2, the debenture holder decided to pull their investments. So now, how can we measure financial ratio? We use debt ratio, which is debt over equity, or leverage ratio, which is debt over equity plus debt, or interest cover, which is PBIT divided by interest. So we want to know how many times can our profit before interest and tax be able to pay our interest on the loan we've borrowed and be well off. So we now have limitation. It does not provide answers to raised questions. It does not focus on long-term sources. So we have non-financial performance indicators, which is very important. Now we're going to look at what are the performance indicators that we can consider in non-financial aspects of the organization. So now the first thing is human resources. The second one is customer satisfaction. The third one is quality. Now, human resources are in charge of employment of the organization, training of the employees, ensuring that the employees are well remunerated, ensuring that employees are staying till closing time, taking unexpected head count. These are where we have to measure our non-financial aspects. Another one is customer satisfaction. How many complaints do we receive in a day from our customers? What is our customers saying? What are they complaining of? What do they want us to improve on? How fast do we resolve the complaints of our customers? Quality. How is our quality? Is our quality good enough to compete with other products? If I'm to take cell phone for example, You see, iPhone is there competing with Android and also competing with other phones. Now, is iPhone qualitative enough to compete favorably with other make of phones like Android? That becomes the question. So we must consider the fact that our product should be of a good quality in order for our customers to come back and patronize us again. So let's look at human resources. What are the things you can measure under human resources? Absenteeism. How many absenteeisms do we have in a year, in a month, in a quarter? Labor turnover rate. What is the labor turnover rate of our employees? Is it high? If it is high, what is wrong? Is it our remuneration system, or is it our promotional system, or is it the system in which we operate? How does it work? We now have productivity. Is our employees productive? Productivity means taking lesser number of resources to achieve the same or greater productivity. So we have idle time. What is the idle time that our workers go without working in a day? If our idle time is high, we need to make it very low. Idle time is a time which I define as when workers spend gossiping without working. Average hours worked and head count. Now, customer satisfaction. Percentage of new and returning customers, percentage of subscribers, number of complaints, and all that. So we now have quality, proportion of item reworked. If the number of items that we rework every day is high, that means we are not doing the right thing. That means we are not producing quality products. For an audit firm, if the proportion of prepared financial statement is high, it means we are not doing the best we can. Proportion of returned items. If the proportion of returned items by customers are high, that means our product is not quality. It's not qualitative, sorry. The numbers of inspection, number of scrap item and all that. Then benchmarking. What is benchmarking? Benchmarking is also used in performance analysis. Benchmarking means standard. Benchmarking in performance analysis is comparing yourself with another person entirely. When you do this, you are trying to checkmate if you are doing the right thing. If you are performing well, as the case may be. There are 3 types of benchmarking identified here: internal benchmarking, competitive, and operational. Internal benchmarking simply means comparing a department in the organization with the best performing department in the same organization. This will tell us if the department is doing well or not. Competitive benchmarking means where you compare yourself with the best performing competitor. Like in an audit firm, yes, a medium-sized audit firm can decide to compare their operations with the operations of PwC, in terms of size, in terms of revenue, to know if they are measuring up or not. Operational benchmarking. Operational benchmarking simply means comparing what you do in your organization with what another organization does in its own industry. For example, ClickCloud delivers lectures through online. Zoom delivers meeting for people through the same medium. Now we have to compare what we do with what Zoom does. You see, we are in different industries. ClickCloud is in the educational sector, while Zoom is in the meeting industry. So we can compare our processes to see if we are measuring up or performing bad. So that is that for that. We'll now look at performance and long-term view. Now, I will just discuss this shortly. Performance appraiser in the organizations are not long-term focused. In fact, they are suffering from what we call short-termism. Now, for example, a manager who wants to be rewarded every year might decide to take a decision that will not favor long-term but favor short-term. For example, a manager that has an aging asset might decide not to replace the asset so that he can have a high return on investment and earn his reward from that. So this is how we look at performance, and we say performance appraiser presently in organizations are not long-term focused, rather they are short-sighted in nature. So organization must ensure that these are long-term focused by promoting sustainability, and sustainability is in the areas of social and environmental. That is that for that. So the note to be provided to you, you read that up. So we'll now look at balance scorecard, which is the last item we'll discuss, then we'll call it a day. A balance scorecard is a concept that was brought into being by Kaplan and Norton. It was brought into being by Kaplan and Norton in the 90s. Now, they tried to look at how performance can be measured in 4 different perspectives, and they identify 4 perspectives, and these perspectives are internal perspective, innovation perspective, customers perspectives, then financial perspectives. Now we'll look at them using a table. I think it will make more sense. Internal perspective: what are the processes that the organization must perform well to achieve their desired goal and objectives? For example, ClickCloud renders lectures through streaming online like YouTube. What are the things we must perform well in the process that we use to stream classes to make our customers, to make our students understand it well more? Another one is innovation. What are the things we must innovate to enable us render a better services than our competitors? Customers. What are the customers' needs, and how do we meet these needs? Upon not identifying these needs, you can now set the targets for these needs and work towards it. Then financial perspective: how do we make sure that our share price is growing? How do we make sure that we are meeting up our goals? So that is that about balance scorecard. You can be given a question or a case study and asked to use balance scorecard to analyze them. This is the 4 perspectives you are expected to write about. So that is that for that. The note will be made available to you right away, so you can study more after you've attended the classes. Thank you, and do have a nice day.